Welcome back, it's Kieran. In this session, I'm going to talk a little bit more about chart patterns. Real life is very different to textbook, but this video will serve as a good starting point. So the first type of chart pattern that I want to talk about is a double bottom. Usually speaking, there's a decline, a push up, and a push down. Sometimes the second low is at the same level, sometimes it's just below with a wick, and sometimes it's slightly higher up. The main point is there's usually two lows. In terms of entry, I usually would wait for this price action to push up further, and once you close above this rough neckline, you would enter a buy. And you can put the stop loss below this low. And in some cases, also you can put the stop loss below the first low. Again, textbook is very different to real life. Certain assets, they have often liquidity hunts, especially for example, Bitcoin. And as any market evolves, naturally the players involved also change as well. And so there can be sometimes a lot of liquidity hunts. And so you want to use a stop loss specific to the asset. But the general principle is that you would wait for the push above and you would enter and put the stop loss below one of these lows. And this often is a bottoming formation. But again, I would not enter purely based on this chart pattern. I would also use other confluences as well. So now moving on to double tops. This usually has a run up like this, a pullback, and then a lower high. The main thing is there's two peaks, and similarly to the double bottom, you'd enter once there's a breakdown, and you put the entry around here, and the stop loss you can put above this high or this high. And again, it all depends on the asset as well. This often is a topping formation, because as you can imagine, when price runs up, it doesn't just come back straight down. It often has a period of consolidation. Sometimes it has two highs, and then eventually it declines. Triple tops is another type of topping formation. There's three peaks usually, and you put the stop loss above the peaks. This is an example of a triple top formation, and we're looking at the daily chart on gold USD. So this was a push up in 2018 for gold, and we have this topping formation. We had one peak here, second peak here, and third peak here. As you can see, real life is very different to textbook. Then eventually we had this pullback here, and we eventually breached the support and we fell much lower. So this is an example of a triple top formation, and this marked the local top for gold in 2018. So now let's talk about flags, another type of chart pattern. The first example is a bear flag. Usually there's a decline like this, and this is what I call the flagpole. And then there's a consolidation period, and it's upsloping, and eventually there's another decline. Usually you would enter at the top of the flag here, or more conservatively, you can wait for the breakout and you can enter at the retest. The measured move of the profit target here is roughly equal to the distance of the flagpole between the top of the channel here to here. The main key points about a bear flag to consider is that often during the consolidation, there's usually a decreased volume on a weak uptrend, and this increases on the sell-off. As you can see here, this is a huge sell-off here, and there's a period of consolidation. Often this period of consolidation is upsloping and it increases in low volume. But once this breakout happens, this sell-off usually happens in high volume. Something else I've noticed particularly over the years is that whenever there's a decline and you have that rise in consolidation before the final push down, often the uptrend does not go above or reclaim the 382 Fibonacci. I've noticed particularly one of the first signs of the downtrend being reversed is if the 382 Fibonacci is being reclaimed. So looking at this example, you can see there's a decline here, and there's a weak uptrend. Often this weak uptrend does not overtake or reclaim the 382 Fibonacci. Often it might just decline here itself. But I've particularly noticed this in huge sell-offs as well. The measured move is a 1-to-1 from the pole to the target. So for example, this distance from here to here roughly equals the distance of here to here for the profit target. And of course, it's not 100%, but it just gives you a rough idea in terms of profit target. And as mentioned before, there's two approaches to entering. You can enter, for example, at the top of the flag here if you're lucky. That entry is much higher. Or a more conservative approach and more realistic is you might get a breakout and then wait for a retest of the channel and then short. Of course, there's no guarantee for entry, especially this high volume, but this is generally the method used to enter for these bear flags. So this is an example of a bear flag that happened for Bitcoin in 2022. This huge decline and sell-off happened, which was greatly influenced because of the Terra Luna collapse. And this is an example of a flagpole. And we have this consolidation, this channel, and we have this other decline here. The distance of this flagpole here roughly is equal to the distance from this channel here to the measured move. And so this is almost a perfect example of a bear flag. If you drew a Fibonacci from this point to this point here, this weak uptrend is roughly still below the 382 Fibonacci. And this is something that I've actually noticed for bear flags. Often the weak uptrend does not overtake the 382 Fibonacci. Of course, real life is never perfect, and there's so many different variations of bear flags. But this is a good example of a bear flag. So now let's look at the counterpart of a bear flag, a bull flag. So in a bull flag, there's usually a strong uptrend, consolidation, and then a breakout. Generally speaking, the consolidation period of a bull flag takes less time than the actual flagpole and the time for the breakout. If the consolidation period, for example, took more than twice as long as the time length of the flagpole, then you might get concerned. In this example, say this run up here took 7 days for Bitcoin, and then you had this consolidation of this channel here. If this period took more than 7 days, then that might be an early sign that actually this might not be a bull flag, and we might not actually get the continuation upwards. Of course, it's not the end all and be all, but it's just something I've noticed, especially from experience as well. The time distance for this flagpole or uptrend here roughly is less than the time distance for this. Usually speaking, the time period of this channel is less than the time period of this uptrend. And as you can see here, we have this breakout. And so overall, the distance of this flagpole from the starting point to the bottom of the channel here roughly equals the distance from the breakout starting point to the actual target as well. Something else also is, in terms of entry, there are a couple of approaches. You can wait for a breakout and then a retest to the top of the channel and then enter the trade. Or if you get a better entry, it would be entering at the bottom of the channel. Very often when you get a breakout, the best approach is to wait for a retest of the channel and then enter along, rather than FOMOing. The only issue is that sometimes you get a breakout, and it might be a breakout on very high volume, and so there's never any guarantee of a retest. I also want to talk about the importance of the 382 Fibonacci in an uptrend, particularly for Bitcoin as well. Very often when you have a strong uptrend like this, and you get a pullback, there's never any guarantee that you actually get the perfect retracement to the 786 or the 0.5. Sometimes you might not even get a retracement to the 382 Fibonacci. And especially with these strong uptrends, these bull flags, I've noticed this. Very often the retracement just slightly front runs the 382 Fibonacci and the uptrend continues. So this is just a certain nuance to actually consider, especially as the market evolves. So now let's talk about wedges. This is another common form of chart patterns. So this is an example of a rising wedge. You have a sloping support and you have a slightly sloping resistance as well. And the price action bounces between these two and eventually breaks out. And you would enter at the breakout here and you put the stop loss above the high. The measured move from the entry point to the profit target roughly equals the start of this sloping support to the top of this sloping resistance. But of course, price action can go much lower as well. So the main key points of a rising wedge is that there's two sloping trend lines, and ideally at least 5 touches. Ideally 3 on one side and 2 on the other. And the volume should ideally decline through the formation, but it's not essential. So now let's just look at an example of a rising wedge on Bitcoin. We had this sloping resistance and sloping support. And of course, there's so many different variations because real life is very different to textbook. But as you can see, we got the 3 touch points at the sloping resistance here. So 1 here, 2 here, 3 here. And then from the support side, we at least got 2 touches. And eventually we got a breakout. In terms of profit targets, the first profit target should ideally be at 382 Fibonacci from the start of the move to the top. And then the 618 Fibonacci from the start of the move to the top. And of course, the start of the move as well. So looking at this example, I would actually take a Fibonacci from the starting point of this wedge and draw it all the way to the top here. The first take profit would be the 382 of that huge uptrend. The next take profit would be the 618 Fibonacci. And the last take profit would be at the starting point of the move. And this is something that I've noticed works quite well with these wedges. But again, you don't want to enter blindly based on wedges. You want to use it as a confluence factor with other analysis. So now let's look at the counterpart of rising wedges. And this is called a falling wedge. In this diagram example of a falling wedge, you can see how, similarly to a rising wedge, there's a sloping resistance and a sloping support. We have those 3 touch points here at the top and usually 2 at the bottom. And eventually there's a breakout. You would enter once the breakout happens here, and the stop loss would be below the low. And the profit target of the measured move would roughly be equal to the distance between the start of this sloping resistance and the bottom of the sloping support. Ideally, there's 2 sloping trend lines and at least 5 touches, so 3 on one side and 2 on the other. And the sell volume should really decline through the formation. And of course, this is not essential, but it's something I've noticed as well. And similarly to a rising wedge, the profit target would be the 382 Fibonacci, the 618 Fibonacci, and the start of the move. So now let's talk about triangle formations, and this is a very important type of chart pattern. Arguably, this is one of the most important chart patterns. So using this diagram as an example, with ascending triangles, there's usually a flat resistance line, and you've got a sloping support. And you see a bounce between the flat resistance and the sloping support. And eventually there's a breakout. With ascending triangles, the breakout generally happens in the direction of the lead-in trend. And in most cases, the lead-in trend before the actual ascending triangle is an uptrend. There's higher lows and there's a flat resistance line. And volume generally decreases until the end of the ascending triangle, and eventually the breakout happens in high volume. Now, this is an example of an ascending triangle based on the recent price action of Bitcoin. And this is looking at the 4-hour chart on Binance. As you can see, we had this rough, flat resistance line and ascending support. We had 1 touch point here, 2 touch points here, 3 touch points here for the resistance. And we had the first touch point here and the second touch point here for the support. Generally speaking, I prefer to enter as a 3rd touch point for support for ascending triangles, and I put the stop loss below the prior low. Another approach might be to wait for a breakout and then long the retest. But if there's a breakout on high volume, there's never any guarantees for an entry. And that is something that's very important to consider. Another nuance that I also want to talk about is that certain people might actually enter on the 2nd touch point of the ascending support. And of course, as you can imagine, this is a bit more risky. There's less confirmation. Because if you enter here, you've already got 2 touch points, and you also have 3 touch points here. There's never any guarantee you're going to get a 3rd touch point. Often you might have a breakout after this point. And as you can imagine, if there's so many touches to the resistance, and if you keep banging on a resistance, eventually it's going to break. Overall, personally, I try to enter at the 3rd touch point, and I put the stop loss below the prior low. If you're more conservative, you might even put the stop loss below this low here. But my personal preference is entering at this 3rd touch point and then putting the stop loss below this low, just for that added confirmation. Some people actually try and enter a long position at the breakout. But again, that is a lot more risky, and the risk-reward ratio is significantly reduced. So this is an example of an ascending triangle that happened on Bitcoin. But as you can imagine, real life is very different to textbook. And whilst you do get many examples like this in Bitcoin, this is a diagram example of when ascending triangles can go wrong. As you can see in this diagram, there's a bounce between the resistance and the support. But sometimes what happens is that you get a breakout of the resistance in low volume, and you can get a move back into the ascending triangle, and then it can break down in the opposite direction. You have to really be flexible and adapt. So you would wait for the breakdown of this ascending triangle and wait for the retest and then short. And so it's very important to realize that actually real life can be different. Sometimes you might get a chart pattern like an ascending triangle and textbook ascending triangle, but you want to pay attention to the breakout, especially the volume when it breaks out. And if it's weak volume, sometimes you might get a move back into the range and you might get a breakdown in the opposite direction. The main learning point here is that do not enter purely based on chart patterns, but it can be a valuable confluence. Now let's move on to descending triangles. There's usually a flat support line and a descending, sloping resistance. And you have a couple of touch points here on the support as well. Usually 3 on the resistance. Sometimes you might get more. And there's usually at least 2 or 3 on the support as well. And you put the stop loss above local structure. And similarly to an ascending triangle, the measured move will roughly equal the distance between the support to the top of the descending resistance. Descending triangles are a continuation pattern. As you can imagine, if the lead-in trend is a decline, there's a higher chance of actually breaking to the downside. Another important key point is that price should touch the top and bottom with minimal white space. So using this diagram as an example, ideally you want all of the space to be filled as possible. This third candle slightly front ran the sloping resistance. And the problem is sometimes if there's too much white space or blank space, you might get a breakout and you might get a move back into the triangle. But again, it doesn't happen 100% of the time. Real life can have so much variation. Another key important point is that volume diminishes with the progression, and ideally there's high volume on the breakout. And in terms of entry, an approach is to enter at the 618 retracement from the starting point here to the low point of the flat support of the descending triangle. But you might not get that perfect entry. A more conservative approach is to wait for the breakout and then short the retest for a descending triangle. But again, there's no guarantee of getting an entry in this context because the breakout might happen in really high volume. This is an example of a descending triangle pattern that happened in Bitcoin. And you can see on the 1 hour chart, there's roughly a flat support, got 2 touch points, and a sloping declining resistance with lower highs. But you can see here, this breakout happened, and this was actually in low volume. And then we moved back into the range. And as mentioned before, there was very little white space, so blank space of the triangle was filled in this context, and we moved back into the range. And actually, we broke out in the opposite direction. So this is an example of how real life is very different to textbook. As with any chart pattern, there's no guarantee it's going to work out perfectly. And even if it breaks out in the intended direction, there's always a chance of it being a fake out and going back into the triangle and the breaking out in the opposite direction. And this is why you also want to consider other confluences as well. So now we've talked a little bit about ascending and descending triangles, which are undoubtedly very important chart patterns. But now let's talk a little bit more about symmetrical triangles. And these are continuation patterns. And usually the breakout is more likely to occur in the direction of the lead-in trend. And as with ascending and descending triangles, it should leave as minimal white space or blanks in the pattern as possible. And the volume generally diminishes as it gets closer to the apex. So this is an example of a symmetrical triangle on ASX, Axie Infinity, a cryptocurrency project. You can see we have the symmetrical triangle, and real life has so much variation. In contrast to ascending and descending triangles, you can see it has a sloping resistance and a sloping support. And you can see this various touch points between the resistance and the support. And eventually we have this breakout. As you can see, the pattern evolved and the volume decreased as well simultaneously. And this was the high peak volume here, and the volume started declining here. And eventually we had this breakout, and this volume suddenly rose up. And again, once we broke out, the actual price action continued upwards, and the actual initial lead-in trend here was upwards. So it's actually more likely to break out to the upside. And there's never any guarantees, of course. I mentioned the term apex, and this generally refers to this region of the triangle pattern here. Now I'm going to talk more about another type of chart pattern called a head and shoulder pattern. So looking at this diagram of a head and shoulder pattern, there's usually a run up like this, a pullback, and this part is called a left shoulder. There's a run up like this again, and this is the top or the head, and a decline, another run up, and this is the right shoulder. And you've got this dotted baseline support here. And usually you get a breakout, and you would enter at the breakout, and you put the stop loss above this shoulder here. The measured move in terms of profit target of the head and shoulder pattern roughly equals the same distance from the top of the head here to the neckline. So this is an example of a head and shoulder pattern in the crude oil chart. And this happened quite recently, and I actually shorted this. Of course, I did not short purely based on the head and shoulder pattern, but it was an added confluence at the time. And the trade worked out very well and hit my profit target. In this context, we had this run up here and a pullback. and this was the left shoulder. We had this run up here and pull back. This was the head. And we had this other run up here and pull back. And this was the right shoulder. Eventually we hit this profit target. And the actual measured move was from the neckline to the head here. And this pretty much mapped out the profit target. Head and shoulder patterns are generally a topping pattern. The volume should ideally be highest on the left shoulder rise. And generally the volume is lower on the head rise. And the lowest volume is generally on the right shoulder rise. And of course there's so much variation, but this is generally what happens. The volume generally decreases as the pattern evolves. And once the actual neckline is breached, there's an increase in bearish or sell volume. And you would short upon the neckline being breached. Of course you can wait for the retest of the neckline once the neckline is breached. But if there's very high sell volume, there's never any guarantee you will get a retest entry. Generally speaking, you want a low volume in the run-up of this entry here. And once there's a breakout, you want the sell-off to happen at a high volume. I want to just highlight also there's so much variation in a head and shoulder pattern, and textbook and real life is very different. This of course is a very good example of a head and shoulder pattern. The left and right shoulder do not have to be the same height. Also, the neckline is not always sloping. Sometimes it's flat. Also, with head and shoulder patterns, sometimes you might get two right shoulders, and so there is so much variation. But the main thing is I've given an example of a common head and shoulder pattern, and with enough chart experience, you will get a better idea of head and shoulder patterns. So in terms of key points, there's no shorting until the neckline is breached. And ideally, you want the breakdown of the neckline on very high sell volume, but this is not essential. And the measured move is generally from the head to the neckline, and this roughly equals the neckline to the target. And head and shoulder pattern, as with any pattern, are generally better on high time frames like the daily chart, and this gives more added confirmation. But of course, price action is fractal in nature. What you see, for example, on the daily chart and the 4-hour chart or 1-hour chart might often present in the 15-minute chart or 5-minute chart. Now let's just talk about the counterpart of a head and shoulder pattern, and this is called inverse head and shoulders. In this example, you can see we had this decline here and a push up here. This formed the first left shoulder. Then we had this decline here and a push back up. And this point here is the head. And this is the neckline. And we had this decline here. And this is the second right shoulder. Eventually we had a breakout. In terms of the measured move, the distance from the head to the neckline roughly equals the distance between the neckline to the profit target. With inverse head and shoulders, if there's a massive increase in buy volume, so in this context, for example, once this breakout happens, often you might get a retest to enter, and you might put the stop loss below the second shoulder. But there's never any guarantees. And if the breakout happens at high volume, then it might just shoot straight past. And in terms of measured move, the top of the head to the neckline roughly equals the neckline to the target. And generally speaking, you want an increased buy volume on run-ups and a decreased sell volume on declines. So particularly in this context, when these run-ups happen, you want higher buy volume, and whenever these pullbacks happen, you want low or very weak volume to show that the buyers are very much in control. But of course, this is not essential. Real life can present very different to textbook. And we're looking at this chart example of an inverse head and shoulder pattern. It's not the perfect example, but this is an example of a left shoulder here, a head, and a right shoulder. And eventually we broke out on high volume, as we can see from the spikes here. So now let's move on to cup and handle formations. This is another type of chart pattern that we see. Often there's a lead-in uptrend here. Then there's a cup like this, and a handle here, small consolidation, and eventually a breakout. In terms of measured move, the distance from this lower part here to the top of the cup roughly equals the distance between the breakout of the handle to the profit target. And this is a diagram example of a cup and handle formation. You can see there's an uptrend here, a cup here, eventually a handle, and there's a breakout. And this is an example of a cup and handle formation using Binance Coin. We had this cup here, as you can see here. Eventually we had this handle, and eventually this breakout happened. And in terms of measured move, the distance from the bottom of the cup to the neckline roughly equals the distance from here to the profit target. So overall, I'm sure you can appreciate that there are so many examples of chart patterns, and real life is very different to textbook. But with enough market exposure, you will learn chart patterns naturally. Rather than just sitting down and trying to regurgitate chart patterns, what I actually think is more effective is perhaps sticking pictures of chart patterns on the wall. And whilst you're trading in real life in the real charts, if you're not sure, just refer to the chart pattern as reference. And this way you pick it up naturally with time. And real life has so much variation as well. And let me ask you a question. When you started driving, did you learn purely based on driving theory? Or did you learn driving by actually getting your hands dirty and just driving the car? You started off driving in a quiet road and eventually you progressed to a busy road. Do not trade purely based on chart patterns, and it's important to stack as much confluences as possible.